Hey guys, Ben here. What is the intrinsic value of a stock? That is a question many of you guys have asked me on this channel, and it seems crazy. We live in this investing world, everyone's investing in stocks, everyone's making a heap load of money, yet people still don't know exactly how to value a stock. What's a company's true value? Because in the words of the great investor Warren Buffett, price is what you pay and value is what you get. Airbnb going public at over $80 billion. Is that fairly valued? Google or Alphabet stock has a market cap of over $1.2 trillion. Is that overvalued? Is that undervalued? Is it a good buy right now? So in this video, we're going to find out, as I'm going to deep dive into my intrinsic valuation model for both Alphabet stock and Facebook. Before we get into that, if you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. And if you wish to take things one step further, hit that first link in the description below to be taken to the Patreon page where you can check out the VIP membership group. This is a special group I set up after many requests from you guys. There you can gain access to exactly when I'm buying and selling stocks, so you guys get the early alerts and the inside scoop. In addition, you get access to my entire investment portfolio, the stocks, and the story of how I grew that portfolio from just $20,000 to over $200,000. So if that's something you wish to find out more about, hit that first link in the description below. I've made a whole video detailing all the different tiers and packages. But with that being said, let's dive in. Okay, so firstly, what is intrinsic value? Now, intrinsic value is the present value today of all the expected future cash flows of the company. Okay, so let's dive in to Google. They are the market leader in search. They are the market leader in online advertising along with Facebook. They also have the world's most popular operating system for mobiles. That's Android. Sorry, iPhone users. But that's not all. They also have the second largest social media platform in the world, YouTube, which has over 1.9 million monthly active users and has also seen a major boost during this global health crisis. Now, personally, I would not call YouTube a social media platform because it's actually productive. I would call YouTube the new television. So really, Google actually has a television network as one of its businesses. But that's not all. There's Google Maps, Google Home, and even Waymo, the autonomous driving company. However, despite all these diversified bets, I came across an astonishing fact. Google still makes over 80% of its revenue from online advertising. So here you can see the revenues for Q3 of September 2020. Now, we've got $37 billion here, which comes from Google's advertising platforms. That's Google search advertising, Google YouTube ads, etc. And from this here, we can see other bet revenues is only $178 million. So I believe that includes Google Home, Waymo, etc. Of course, Waymo is not making any money yet because it's still in research and development. So it still shows you that really that is a speculative part of the business at this point in time. Now, Google Cloud is a very interesting service. They're not the market leader in cloud, but I believe they are third after Amazon Web Services and Microsoft Azure. I believe Google Cloud can offer a fantastic opportunity for Google to continue its growth. Having said all that, $37 billion from Google's advertising revenue and only $46 billion in total. That's for Q3. So that's around 80% of Google's revenues from advertising. So what I've got here is three scenarios. Don't be alarmed by all the numbers and colors. Three simple scenarios. I've got an average case for Google, a best case, and the worst case. So let's start off with the average case. So what I've done here is inputted the current cash flow for the business, which is $31 billion. And then I've extrapolated that out at a 19% growth rate, which was predicted by the analysts for Google stock. And then the next 5 to 10 years, I've said that that drops to around 10% growth rate because as a company gets really large, it does find it difficult to grow. And I'm going to give you a simple example of this right now. So let's say a company has a market cap of $30 billion and it manages to increase its revenue by $6 billion. That's fantastic. That's a 20% increase. But let's say a company has a market cap of $300 billion and it manages to increase its revenue by the same amount, $6 billion. That's only a 2% increase relative to the company's market cap and let's say existing revenues, which are also going to be higher given that market cap. So you can see what a tough time really large, gigantic businesses have on sustaining major growth. If anything, these tech giants we're seeing right now, Facebook, Amazon, Google, Netflix, they're actually breaking new ground by continuing to grow at such a fast pace with their incredible size. I've added a terminal multiple, which is like a price to earnings ratio, which is the current price to earnings ratio for Alphabet stock of 28. Computing those figures in, we get a present value, a market value for the company of around $1.6 trillion. Now, to put that into perspective, the current market cap for Alphabet is $1.19 trillion. So basically, in the average case for Google stock, if you invested into it today, at today's cost basis, you have an upside potential of approximately 34%, and that could be over a period of 10 years. It could happen in 1 week, it could happen in 1 month, but over a period of 10 years, despite the ups and downs, we could expect to see around a 34% increase, which is still very good. But now let's dive into the best case. For our best case, we're going to assume the online advertising revenue for Google continues to grow via, say, YouTube, which does seem to be the main growth driver for Alphabet. Then we're also going to assume Google's cloud revenue continues to grow at a fast pace. And we're also going to assume that Waymo, the autonomous driving company, which Alphabet owns, becomes very successful and starts producing revenue for the company. Let's say they license this self-driving software to automakers in order to make their vehicles autonomous. It does seem quite likely in the future. So using those figures, I've increased the growth rate on Alphabet stock to 25% from 19%. And for the next 5 to 10 years, I've still dropped that down to 10% due to the company's size. Now, a discount rate I've added of 10%, same as the previous case, and basically that means that's my required rate of return. We can use the US Treasury figure, which is supposed to be your risk-free rate of return. So despite all the crazy money printing going on, the US government should be able to pay its debts. Now, if you guys want to know more about this, I've actually got this spreadsheet available for you guys to download in the VIP group. So I'll leave a link for the terminal multiple. I've increased that to 35. We'll call that a price to earnings of 35. And that gives us a market cap, potential market cap of $2.39 trillion. And if we compare that again to Alphabet's current market cap today, we can see the best case scenario, we've got 100% returns on our investment if we invested today at today's share price. Okay, so now let's look at the worst case scenario. Online advertising for Alphabet still makes up 80% of the business. They've actually achieved full market penetration, or they're actually losing market share on their online advertising to, say, Facebook. And we'll also say Waymo is still making no money. Google Cloud is growing quite slow as Amazon is eating all that market share. So what's the worst case? So with the worst case, we'll say the growth rate dropped to 10% for the next 5 years, which I think is extremely unlikely. The next 5 to 10 years, 10% again. Terminal multiple drops because everyone thinks Alphabet's done. Maybe there's an antitrust investigation again. Terminal multiple drops to 20, and that gives a present value market cap of $873 billion. Okay, so even with all that bad news baked into the stock, that's a minus 26% decline from this current level we're seeing right now. Personally, I think that case is extremely unlikely. And finally, I've done a probability of each scenario. So I've said 50% for the average case, 30% for the best case, 20% for the worst case. This is just my personal opinion. You guys feel free to play around the numbers yourself. I've divided that by the total number of shares outstanding to give us a fair value per share of $2,423 per share. Now, Alphabet share price today is $1,752. So you can see there's plenty of upside still in the stock for Alphabet. So to me, the stock is still a buy at these levels. Buy the dip! Okay, so now on to Facebook. Very similar story. Growing tech giant, massive company, the leader in online advertising along with Google, but they're also seeing their growth slowing in their traditional businesses. So let's dive into their earnings report right now, and I'll show you what I mean. Okay, so Facebook's daily active users is starting to slow. We can see it was around 1.6 billion in Q4 of 2019, and that's increased to 1.8 billion in Q3 of 2020. I believe the older generation are the people who are signing up for Facebook now, especially due to the global health crisis. They are the people who are signing up now, but still, the growth is starting to slow. Almost everybody's got a Facebook account now. Now, one great thing I did notice about Facebook is their effective tax rate has actually improved massively. So they were paying around 20% tax in Q4 of 2019. Now they're paying just 4%. So they have some crazy tax loophole set up. I believe that's in Ireland, actually. Yeah, fantastic for Facebook, I suppose. But really they should be paying a bit more tax than that. But there you go, that's big business for you.
Excellent.
Comment below if you're shocked by that 4% tax rate and you'd like to pay that yourself. Okay, so the real question is, if Facebook's user growth is starting to slow, where is Facebook going to obtain its growth from? Well, firstly, it's introducing many new features into its platform in order to get people back on the platforms. Examples of this include Facebook Marketplace, Facebook Shops. They're even introducing a dating service. But the more exciting growth driver for Facebook has to be their virtual and augmented reality systems through Facebook Horizon and Oculus, which Facebook acquired a few years back.
Live demo in VR. That our minds can just automatically understand the facial expression, so I can understand what you're feeling right now.
So we can actually make eye.
But as mentioned previously, due to the size of the company, I don't think those revenues will have a major impact on the overall revenue increase for the company. Not in the short term anyway. Okay, so let's dive into the valuation model now, and I'll go through it with you guys. So Facebook, I've said a 17% growth rate for the next 5 years, which is from the analyst estimates, 10% after that. A multiple of 26, which is where it's trading at right now. That gives us a market cap of $1 trillion. Now, Facebook's market cap today is $778 billion. So basically, that gives us an average case upside of 26% for Facebook. Okay, so now let's go into the best case. Let's say their platform improves, people start using Facebook again, and they're not using all the other platforms as much. Let's also say their augmented reality systems hit a wave and people start adopting them in every single home across the world. That gives us a valuation of $1.379 trillion. So that's a best case upside for Facebook stock of 75%, which we can expect to see. Okay, so now let's go at the worst case. So the worst case, we could say Facebook gets hit with an antitrust investigation again. The user growth continues to slow. Maybe Google takes some of their advertising market share. So in that situation, we could say a 10% growth rate for the next 5 years and 10% continuing. And the market cap could be $648 billion. So that's a decrease of around minus 17% from the current $700 billion market cap for Facebook. So this gives a total sum and a fair value per share for Facebook, drumroll please, of $369 per share. Facebook's share price today is $273 per share. So to me, Facebook is still buy.
Buy the dip!
Okay, so that's the intrinsic valuation. I hope you guys enjoyed that. If you did, feel free to give the video a big thumbs up. That helps out tremendously with the YouTube AI. And if you guys haven't joined the community yet, what are you waiting for? Feel free, join the investing family by hitting that subscribe button and turning that notification bell on. And if you want to take things one step further, first link in the description below to be taken to the Patreon page. Check out the VIP membership group, full video there outlining all the different tiers and packages. You get access to my buy and sell signals, so when I make my moves, you can make your moves, in addition to my entire investment portfolio, the stocks, and the story of how I grew that portfolio from $20,000 to over $200,000. But that's not all. You also get access to our private Discord chat. This is a family of like-minded investors, all moving towards a successful point in their life. That is the place you guys can be a part of it and get access to the inside scoop by speaking to me directly. And when I've actually got time, and as long as the group doesn't get too large, then I will be able to dedicate more time to you guys to speak to you individually about your portfolios or just about life in general or other investments such as property, real estate, etc. But my suggestion would be to join the VIP membership group as soon as possible, because the smaller the group is, the more time I can give to people. As it gets too large, it's going to be really, really difficult. So the earlier the better for you guys. With that being said, I hope you guys have a tremendous day, and I'll see you in my next video. Invest safe.